Most Australians don't fail at property because they choose the wrong suburb. Property is risky because of the investor. All right, I'm going to say something that most property educators will never tell you. Buying an investment property too early can set you back 5, sometimes 10 years financially. And here's the scary part. Most Australians don't fail at property because they choose the wrong suburb. They fail because they invest before they're actually ready. Today, I'm going to show you exactly how to know if you're financially and mentally ready to invest in property using the same framework we use when assessing clients at InvestDoor. And stick with me because later in this video, I'm going to show you the single readiness factor that quietly destroys more portfolios than interest rates ever will. So let's start with some honesty. Right now, Australians are being bombarded with property content. TikTok is telling people they can retire by 35. Instagram is full of overnight success stories, and dinner tables everywhere are filled with conversations like, mate, property always goes up. But here's what nobody talks about. Property is not risky because of the market. Property is risky because of the investor. Over the past decade working with investors, I've seen something very consistent. The people who succeed long-term don't necessarily earn the most money. They don't always buy the best deals. They simply start investing at the right time in their life. And the people who struggle, they usually rush in emotionally and then spend years recovering financially. So today, I want to give you a clear, honest, and practical framework to help you assess your readiness. Not hype, not motivation, just clarity. So here's the first and biggest misunderstanding Australians have. Borrowing power is not investment readiness. Just because a bank says you can borrow doesn't mean you should. Banks assess whether you can service a loan today. They're not assessing whether you can hold that property through interest rate rises, vacancies, maintenance costs, life changes, even economic cycles. Let me give you a quick real-world scenario. Let's say Sarah earns $110,000 per year. The bank approved her for a $100,000 investment property. On paper, she looks ready. But when we look deeper, after tax income, roughly $7,000 a month, mortgage repayments is $3,800, living expenses $2,900, insurance and maintenance buffers on top of that, an extra $600. That leaves her with negative $300 monthly. Now, could she still buy property? Technically, yes. But here's the question serious investors ask. Can I hold this property comfortably for 10 years if nothing goes perfectly? That is the real readiness test. If one unexpected cost creates stress, you're not building wealth. You're gambling on stability. Strong investors prioritize holding power, not purchasing power. Now, let's talk about something most people underestimate, and that's time. Property wealth is rarely built in short bursts. It's built across cycles. In Australia, historically, property cycles can often span through 7 to 12 years. That means if you buy today, your investment success is tied to your ability holding long enough to ride through multiple growth phases. So here's a simple question. If your property drops in value for 3 years straight, would you panic? Or would you stay confident in your long-term strategy? Because both scenarios happen in property markets. Let's take a quick look at an example. So an investor purchased a property for $600,000. Over 10 years, assuming 6% average growth, the year 10 value is approximately $1.074 million. So the growth there is $474,000. But here's the part people ignore. Within those 10 years, there are often periods where values stall or even fall temporarily. Short-term thinkers sell during flat markets. Long-term investors accumulate wealth during those same periods. So the readiness question isn't, will property grow? It's, can you stay invested long enough for growth to matter? All right, so now this one that I'm about to talk about is the silent killer. Most people think property investing is a numbers game. You know what? It isn't. It's a behavior game. Let me tell you something confronting. 2 investors can buy identical properties, same suburb, same price, same rent, and one becomes financially free while the other sells at a loss. Why? Behaviour. Let me paint a realistic Aussie scenario. Interest rates rise by 1.5%. Media headlines scream, property crashes come in. Your property is vacant for 6 weeks. Suddenly, your investment feels like a mistake. This is where investors make emotional decisions. They refinance badly, they sell prematurely, they stop investing altogether. Successful investors don't avoid stress, they prepare for it. The question isn't whether property investing will challenge you emotionally, because it will. The question is whether you've built systems, buffers, and education to stay rational when it does. And this leads into something most investors completely ignore. There is one hidden readiness factor that determines whether investors build multiple properties or stop just after one. I'll explain that very shortly because it might completely change how you think about property. So let's talk about expectations. Property is often marketed as passive income, but here's the honest truth. Property is front-loaded effort for back-loaded reward. So early stages of investing usually involve learning financial structures, managing cash flow adjustments, handling tenant turnover, navigating maintenance, and reviewing strategy regularly. The payoff comes later through your equity growth, your portfolio leverage, rental increases, and compounding capital. Let me give you an example of a simple portfolio example. So an investor buys the first property at age 30. So the first 5 years, there's minimal lifestyle change. There might be slight negative cash flow, and moderate equity growth. Years 6 to 15, this is where equity starts to snowball. Second and third properties are acquired, and rental income begins accelerating. By year 20, their portfolio produces strong passive income, debt is significantly reduced, and net worth is dramatically higher. The biggest mistake investors make is expecting year 20 results in year 2 timelines. That mismatch destroys confidence. Remember earlier, I mentioned there is one factor that quietly determines portfolio success. And here it is, ownership mentality. Let me explain. Consumers look for products. Investors take responsibility for outcomes. Consumers ask, what property should I buy? Investors ask, what investor do I need to become? Consumers chase certainty, and investors manage uncertainty. And this mindset shift is subtle, but it's powerful. The investors who succeed long-term are not the smartest. They are the most accountable. They understand that the markets fluctuate, loans change, tenants move, and life happens. But their commitment to the strategy stays consistent. And this is often the biggest difference between someone who owns one investment property and someone who builds generational wealth. So if you're wondering whether you're ready to invest in property, here are 5 readiness checkpoints. Number 1, financial holding power, not just borrowing power. 2, long-term time horizon alignment. 3, emotional tolerance for market cycles. 4, realistic expectation of effort versus reward. And 5, ownership mentality and accountability. If you're strong across these areas, you're already ahead of most Australians entering the market. Now, if this video has challenged how you think about property investing, I want you to drop a comment below and tell me which of those 5 areas do you think Australians most underestimate. And if you found this helpful, make sure you like and subscribe because this channel is all about helping Australians build wealth through education, not hype. And if you're still sitting there watching this and thinking, look, I like property, but I honestly don't know where I sit in terms of readiness. That's exactly why we built what we call the Investor Readiness Assessment. It's designed to help you understand your financial position, your behavioral investment profile, your risk tolerance, and your long-term strategy alignment. Because here's the truth. Most people don't fail at property because they choose a bad suburb. They fail because nobody helped them build the right foundations first. If you want clarity around your investment readiness, you can book a strategy session with our team. We'll walk you through your situation, your goals, and help you understand whether property investing is appropriate for you right now. And look, if it is, what your next smarter step could look like. There's no pressure, no sales scripts, just structured, honest guidance. You'll find the link in the description below. And remember this, property investing isn't about rushing into the market. It's about staying in the market long enough for compounding to do the heavy lifting. And the investors who win are usually the ones who prepared properly before they ever signed their first contracts. Thanks for watching. I'll see you in the next video.